I mean, the prices of these stocks compared to their earnings are just sky high, way above historical averages. They need to grow at an incredible rate for the next decade just to justify the prices people are paying for them today. And that adds a whole lot of risk to what's supposed to be a safe investment.
Okay, so you see all this. What do? Well, for the investor telling this story, it meant it was time to make a change. Not, selling everything and running for the hills, but a careful, deliberate pivot to get some of that lost diversification back.
And I have to stop right here and say something really, really important. This is one person's journey, their thought process. This is absolutely not financial advice. It's just a way to think about your own investments, not a prescription for what you should do, okay?
All right, so here's the actual plan. It was to reallocate about 25% of the investment into 3 different buckets. First, an S&P 500 times value fund, which basically filters out those super high-growth tech stocks. Second, a mid-cap fund to get exposure to smaller U.S. companies. And third, an international fund to stop betting on just one single country's economy. Now, this is a really important detail. 75% of the money stays exactly where it is. This is not about ditching the old strategy completely. It's more like hedging your bets. It's an adjustment to manage this new concentrated risk while still keeping most of your money in that core S&P 500 fund. At the end of the day, this story isn't really about a specific stock-picking strategy. It's about something much bigger. It's about periodically checking under the hood and making sure your investments are still actually doing what you hired them to do. And this whole strategic shift is really based on one huge question about the future of AI. Who is actually going to capture all the economic value that AI is supposed to create? Because there are really 2 very different ways this could all play out. So, on the one hand, the way the S&P 500 is structured right now is a bet that the big guys just get bigger, that the giant tech companies building the AI models will suck up all the profit. But there's a whole other possibility. What if AI becomes a cheap, easy tool that thousands of smaller, more nimble companies use to create amazing things in medicine or manufacturing or retail? In that future, the value doesn't go to the AI creators, it goes to their customers. And this quote it sums up the whole problem perfectly. The old, safe advice, just buy the S&P 500, suddenly feels risky because the S&P 500 itself isn't what it used to be. It's not that broadly diversified investment anymore.
And that really leaves us with a final question for you. Take a look at your own safe, diversified investments. Are they still really doing the job you hired them to do? Or have they, without you even realizing it, turned into a huge, concentrated bet on a future that you're not so sure about? It's definitely something worth thinking about.